Hi, everyone. I'm Rick Bensignor. Today is Tuesday, April 19th, and welcome to this week's In the Know Trader show. As we start off recording late morning, S&P is up handsomely, up 1.3%, about 57 points or so. The Qs, the NASDAQ 100, is up about 1.8%. The Dow trailing there, only up just over 1% or so. Big catalyst for this move, crude oil down 5% today and natural gas down almost 10%. And that is what is giving a lift to the markets. Those, both are major inflationary types of moves they've had recently, especially natural gas, and seeing it have a big pullback today is just another reason why the market's moving higher, as well as the fact that both the Qs and the S&Ps last week, I think it was Tuesday of last week, marked daily setup minus NAND counts, and they have consolidated since and now getting the up move that we kind of were expecting to see from that signal. So you're seeing some short squeeze and people coming back into the market on a day like today. U.S. 10-year rates, 2.89% today. They've been as high as 2.93. The long bond, which is the 30-year bond, actually climbed over 3% today. Bitcoin's up almost $1,000. The dollar's up just shy of, this is the dollar index, just shy of 101. And gold taking it on the chin today, down about $30 or so. So that's how markets look. Let's get into today's show. Trader education, we're going to talk about the difference between strategic investing versus tactical trading. In our market overview, we'll take a look at charts of US 10-year, the GLD ETF, which is the gold market ETF, and then Bitcoin. I look at them in terms of Bitcoin futures. To me, the most reliable data is Bitcoin futures. And then the sector focus, because technology has been such a dog this year, I figured let's go take a look at some of the biggest names there, and I'm sure many of you have positions in these names, and therefore I figured it makes sense to take a look and see what the charts say. To sign up for In the Know Traders weekly ETF Tactical Trader Report or my 7-Eleven monthly Spider Sector ETF report, go to inthenowtrader.com. The weekly report gives you a very full macro overview of what's going on, digs deep into key levels in the S&P, gives you a new ETF trading idea each week, as well as walks you through every open ETF trade idea we have until we close the position out. And then the 7-Eleven report is designed to outperform the S&P. We use the spiders as our benchmark, and what we do is invest in no more than 7 of the 11 S&P sectors at any one time over the course of the month, with the goal of staying away from the underperformers and trying to concentrate our bets in the outperformers. Through March 31st, well, in the month of March, sorry, better say, so last month we outperformed by 20 bips. For the year, outperforming by 1.71%. For our fiscal year, which started August 1st of last year, we're outperforming by 2.62%. And since we started this in August of 2020, we have outperformed by 6.16%. So we are having not a great month this month. I know we're underperforming, but if you take a look at these numbers, we are doing fantastically well. I don't use that word too often, but when you're operating in 20 months, we're outperforming the S&P by over 6%. That, as I've said before, puts us in the top 10% of all active money managers here. And we are not managing your money. We're advising you what to do with yours in this monthly report. And if you're looking to do better over time than the S&P, then you really should take a look into the 7-Eleven report. Okie doke. What else do we have? Let's take a look at the sectors. So here's year to date, excuse me. Energy, even with, well, this is not including today, obviously, we've got a down day in energy, but still huge outperformer. Far and away the best of the year after having had years of being the worst, energy continues to be the sector to be in. Take a look on the left-hand side here. So the far left is the spiders themselves, down 7.5% going into yesterday. I'm sorry, going into today. That's last night's close. You'll see technology and communication services really lagging badly, down virtually twice what the S&P is. Consumer discretionary down 12%, so a significant underperformer too. Everything else is outperforming, but the ones that are really kind of shining now are the ones that can be up in a down year, and a down year of significance, 7.5%. So energy, staples, utilities, all still doing, in positive territory. Healthcare and materials close to that break-even line and doing well better. So that's a look there. Let's get to our trader education portion and talk about strategic investing versus tactical trading, the differences as well as the troubles you can get yourself into. So here I just put together the slide a few minutes ago to kind of just give you a very basic overview. Strategic investing is a long-term perspective on the market. And notice I'm talking about strategic investing versus tactical trading. And they are two very different animals, and we should be doing a mixture of both with the bulk in your strategic long-term investing. So what does that mean? It's looking at the long-term views of the market based upon the macro investing environment. In other words, all the key influences of whether or not you should be invested at any given time. It includes, but certainly is not limited to, earnings expectations for the stock market, where the multiples lie in the stock market. In other words, is the S&P, is a sector or any individual stock that you're considering trading at a high multiple historically or a low multiple historically. And that is important to understanding how, when, and where you want to be strategically invested. You certainly want to understand what the Fed's stance is. And of course, in 2022, that is a major shift from what had been a very accommodative Fed to now a very non-accommodative hawkish Fed. And that influence on the potential returns over time for being invested. And then, of course, the long-term technicals of the market, not the short-term technicals. So if you are strategically investing, you should not be looking at daily charts, 30-minute charts or anything like that. You should be looking at longer-term charts, which would include, to me, weekly charts and even monthly charts, and not caring about the little moves in the market, but trying to understand the bigger moves and whether or not, let's say, the environment we're in now is one that you're still comfortable being strategically invested in. And we'll talk more about that in a minute. Let's now compare that to tactical trading. So what is tactical trading? That is much more shorter term views of what's going on in the market based upon near term, the micro trading environment. In other words, what's going on now, and then the near term I usually define as a couple of months or less, including but not limited to upcoming earnings announcements. Or are you going to tactically play an announcement? In other words, if you do your homework and you think that the stock is going to outperform its earnings announcement, then it may be something that you want to try to take advantage of, either playing outrights, using options, multiple ways of doing that, but that is a short-term type of view, playing a particular earnings announcement. You could be playing a potential news headline that is either upcoming or has just come out. So if a company beats on an earnings report, and of course we're in earnings season, That may be a reason why you want to jump on that name, but it doesn't mean it necessarily is something you want to be strategically invested in for the long haul. When you're talking about tactical trading, you want to understand the sentiment of the market and getting a sense of how people are positioned and what is the general view. Are people bullish, bearish, and where are they bullish and bearish, and how long have they been bullish and bearish? So for instance, last week, the American Association of Individual Investors, the AAPL poll, which comes out every week, showed roughly 16% bulls, the lowest level since 1992. So bulls are going to jump on that and say there's virtually nobody bullish in the out there in the public, the individual investor category. We're not talking about professionals, but the individual investors were only 16% bullish. That is such a low number that those who are contrary opinion players will say that that is the reason why you need to be bullish now, is because there are so few. So it's, it's understanding sentiment and trying to take advantage of that. So tactical trading with a short-term view of the market should have a very different approach that you take as compared to your longer term strategic investing. And it really comes down to what do you want to be invested in, which names, which sectors, which indexes, even is it, which asset classes you want to be in at any given time, and the split between them, that is strategic investing. Playing shorter term technicals and a trend line and a moving average held as support, let's buy the stock, that is short-term tactical trading. And it may work out beautifully that ultimately you end up holding something, but here's where the problem becomes. And that's when you mix the two because of error, not because it was your game plan. It's taking a tactical trade that you're leaning on a level or an earnings report or some news event. It doesn't go the way you expected. The stock goes adversely to how you positioned for it. And all of a sudden, in your head, you go, I don't want to take the loss. Let's just put that in my brain into our strategic long-term investing category. That's where you get in trouble. Usually not a good way to play the market. And despite the fact that generally over time, stocks move higher, take a look at some technology names that you might have purchased last winter, a year ago, that are now worth 40, 30, or, well, let's just say 30, 40, or 50% of where they were a year ago. That's what happens when you make a blunder and you take a loser and throw it into, oh, let's make that a long-term hold. That's not a good way of thinking about being a tactical trader. Taking stuff from that theoretical portfolio and switching it to your strategic long-term portfolio is usually a recipe for significantly lower returns than you would have, because you're still carrying real substantial losses from names that you should have gotten out of much more quickly when the trade idea simply didn't work. So when your tactical trade doesn't work, you get out of it, you take your loss, you regain your cash in order to play something else, and you don't mix that into your strategic long-term investing, because the things that you're looking at for long-term investing should be significantly different than what you're looking at for short-term. And if you think of this just in the sense of the market's up big today, we told you, it's up very significantly today, having bounced on some support. But if you look at what the market's done since January 1st this year, this move is, still somewhat inconsequential. You still have a Fed that is going to be hawkish, fighting inflation, et cetera, for months and months and months, if not, a year or two to come. More Wall Street firms are thinking that in 2023, we could potentially get a recession. These are bigger picture items that you need to put into the whole incorporate into the whole process of determining what is your strategic play. So when I think about mine now, I look at all the macro headwinds that we have, and I think to myself, well, and I've been telling you this now for pretty much the bulk of 2022, is that we have, for the first time in a while, a two-way market, as compared to what for years has basically only been, let's buy the dips. Let's find out where to buy the dips. That is probably no longer the only way to look at this, because I think you need to also look at this in terms of selling rallies. There are real macro headwinds. Inflation is out of control. You've got the war in Ukraine and Russia, and what that is doing to the supply chain and potentially corporate profits, and certainly how it's affecting inflation. You have a Fed that has turned hawkish, and very notably hawkish, essentially self-proclaimed hawks at this point, which is very different than we've seen in the last 12 years. So instead of just thinking of, okay, let's buy the dip, it probably makes sense to think of also doing sellings on rallies against resistance, and looking at your entire investing portfolio as something that probably needs some real adjusting for the first time in a long time. So anyway, that's what I wanted to talk about today. The difference between strategic stock investing and tactical stock trading, and how you approach them, and not to switch one to the other, especially if you've got a long-term view on something and there's a short-term, you could have one quarterly miss, doesn't mean you have to dump out of the stock, because one quarter's miss may hit it for a month, but long-term, it's the right play to be in. So it works in both directions as far as what, don't cross in either from strategic to tactical, or from tactical to strategic, because what you thought was going to happen didn't in fact play out. All right, let's take a look at our charts. So here we go. And let's start off with, not this chart, we'll get there shortly. Let's take a look at TNX. All right, so here's the weekly chart of the US 10-year, and we have gone through the 2.5% area, which was my upside target for certainly the first half of this year, and we've blown through that. But what I want to do is put up the combo, which is another way, another one of Tom DeMar's models that counts towards 13, looking for potential upside exhaustion. And the reason why combo is important is that the all-time low, so you'll see here, I'm circling with my pointer down here. In fact, let's just put a little ellipse around it. Notice that the all-time low in yields was a combo 13 to the downside. In other words, downside exhaustion of the trend. We are now on the first combo upside exhaustion signal that we've had since the bottom was made. And it doesn't mean yields have to stop here. What it does suggest to me is that we are late in this rally, and that if you first sell bonds now, selling bonds is the same thing as being bullish a yield chart. If you first sell bonds now, the odds of success are greatly reduced compared to virtually any other time that you would have considered doing that in the last year and a half. So this signal up here now is suggesting to me that this is probably not the best time to first decide. I've been telling you since this setup 9 count here, I'm going to just make this a different color so it's easy to distinguish. This yellow circled area is when I said you simply do not want to own bonds anymore. And that is where I personally, and I told you at the time, had sold out and hedged my bond portfolio myself, such that anything moving higher was not going to affect me, right? Yields moving up was basically what I did is I stopped playing the 30-year move in bonds that were bullish for bonds, bearish for rates, to say that at this point, I'm playing for rates to go higher and I don't want to have the long bonds anymore. doing that and having bought the yield chart or having sold bonds here is very different than first selling bonds now. And so I'm cautioning people and my clients, this is not the time or place to first be thinking of doing that. It doesn't mean rates can't go up. It means that the risk in doing it is far greater than let's say, when we had done the same idea back in July of last year. That's the TNX chart. Let's take a look at gold quickly, because gold is getting clobbered today. They are taking commodities down across the board today. So here's a weekly chart. If we were to look at this in terms of actual gold instead of GLD, but the price of gold bullion in the futures markets, we again got to $2,000 on the highs this week. The all-time high is $2,064. So we continue to get close to it, but fail from it. In the bigger picture, so there's tactical and there's bigger. In the bigger picture, as long as we kind of stay above the middle Bollinger Band, having gone sideways for a long time and then breaking towards the upside, I want to see at this point the 175 level hold in GLD. Otherwise, this could just be a temporary pullback, again, a tactical type of short-term move. But with a chance that gold could still make its way higher over time, which is what I'm still personally, I'm holding on to my gold and still think that, it can go higher. Let's quickly look at Bitcoin before we get into some of those tech names. And what I had told people is on this weekend is that Bitcoin's set up 9 count. This is a daily chart now. So notice the last few 9 counts, 9 on the high, 9 on the low. Now we have another chance for 9 on the low that was right against the TDSD line, which is the lowest low in this 9 count going up. So over the weekend, I suggested people buy Bitcoin with a fairly tight stop. And so far this is working. And, I'd say now you have more risk to doing the same thing, but closer to under 38,810 in the futures would knock me out. But I kind of like this, and it's trading somewhat. There's been analysis done on the street that Qs and Bitcoin have similar looking charts, and you kind of have the risk on, risk off being similarly done. Let's take a look at some of these individual charts now. Let's see, what can we take away? So let's look at Apple on a weekly chart. Notice, and we're certainly not going to get to all of these, so whatever we don't get to this week, I'll just simply do next week in the show. So we'll go through the really key names in the tech sector. So it starts off with Apple. Notice that this week's low, propulsion exhaustion level, plus the coming together of both the conversion and the baselines. As long as we're kind of above there, then I'd say for right now, Apple, it's still a hold. When you look at this strategically, this has been in a long-term uptrend. We're above the cloud. So I kind of like if we close, even if we close this week above 186.70, I'm sorry, 166.70, what do we have here? 0.78. So we close above this hyphenated green line this week and gap higher next week, then we should target actually new highs. So for now, I think Apple's still good. I don't have a reason to be materially concerned. Where would I strategically think differently about Apple? Probably if it got much beneath this 143 level. Otherwise, this is noise, and you deal with the noise for a long-term hold, which has been a spectacular name over time. So there's short-term trading, there's long-term strategic investing. From a strategic investing point of view, there's no reason you think about getting out of Apple. Microsoft, this will actually be the last one we do, and maybe next week I'll just go through all these names, again, and I'll start with Apple. And Microsoft holding, look how it's playing, against the top of the cloud. This is a weekly chart. We know that this is going to be, there are going to be buyers against this type level. And you know, we're essentially at the same price now, meaning, well, not the same price, the top of the cloud now. We want to see it poke through, and because the angle of the top, it still may bump into it over the next month or two. But again, seeing the pullback to the monthly cloud gives you often a chance for longer term strategic investing. Notice back here in early, when was this? March of 2020. So this was the COVID sell-off. Notice the low goes right to the top of the weekly cloud and then turns around and zips and more than doubles in price into last fall's high. So this still is in a place that I'm willing to be long strategically. Tactically, you can play, you know, you can draw a trend line and play against the trend line on a rally, but in a general bigger picture, it's still okay. And that's all we have time for this week. So I will do the whole tech sector again next week. I hope you got value out of the education part about strategic investing versus tactical trading. I'm Rick Bensignor. You've been listening to In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.